This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the Young Wealth Show, where you'll truly learn how to make, spend, and invest money for an awesome life. Get the real-life stuff that wasn't part of your school curriculum. Young Wealth gives you innovative new ways of dealing with your finances, as well as the skills and tools you're going to need to survive and be successful out on your own. Let the Young Wealth Show be your GPS to take you from clueless to clued in. Here's your host, Jason Hartman, with Young Wealth.
It's my pleasure to welcome Amanda Hahn and Matthew MacFarland. They are the author of two great books on tax strategy. One, the most recent, is the book on advanced tax strategies. And we're going to talk about several things that apply to real estate investors today. And Amanda and Matthew, welcome. How are you?
Good. Thank you for having us.
Yeah, we're so excited to be here.
It's great to have you. So I really enjoyed your book, first of all. And, you know, there are just not enough competent people out there in the tax world that really kind of focus on real estate, especially. That's why we're excited to have you today. And there's so much we could talk about, as we discussed before we started here. You know, we could talk about self-directed IRAs. We could talk about a zillion things. But we do have an election coming up and some pretty significant changes are in the wings if Biden wins. If he doesn't win, I think we'll just see, more of what we saw a couple years ago. My biggest fear is the 1031 exchange would go away. A lot of people are talking about that one. Biden wants to get rid of it. He's stated that. Do you have any thoughts on that and its impact?
Yeah, that's an interesting one because, actually under the last tax reform, the Tax Cuts and Jobs Act, there was a big change that was already made to the 1031 exchange where,
right,
used to be eligible for other assets, but now it's only specific to real estate. So I guess I think it's not hard to imagine it just going away altogether. And that would be unfortunate because real estate has done so well in the past couple of years. And, in our office, I don't know, how many 1031 exchanges do we see on a daily basis now?
We joke with our staff. It's like, hey, we've got another one, so.
Yeah. So many. And people exiting California, going to other states, or exiting one state to another. We see that all the time.
Yeah, it's really something. I think that would be very bad for the economy if the 1031 exchange went away. I think it would discourage investment. It would also make the market more stagnant because people that would otherwise sell and create income for so many people, accountants, of course, but 1031 exchange, accommodation companies, the lawyers, the tax experts, when people buy a property, they typically improve the property because they have different ideas for it. So all those contractors, all those appliance companies, et cetera, it would really change. Let's hope that doesn't go away. Why don't you go ahead and share your screen and tell us some of the other stuff you're thinking about?
Yeah. So we wanted to put up a slide first of what the current tax rates look like, just so we, get an idea. And you can see the current tax rate and at the highest level.
For those of you who aren't watching on video, if you're listening only, try and elaborate on the slides so someone with audio only could understand them. But they will be on our YouTube channel.
So yeah, the first thing we kind of just touch on real quick is just looking at, we've got a picture of tax rates at a glance right now. So we've kind of put some colors to this where you can kind of see if you're a single person, you can look at your income range on the left, or you're married, you can look on the right. But you can obviously see the highest tax rate right now is 37% for the IRS. And we've got the capital gains rates broken out. But what's interesting about this is that, as you were kind of talking about, maybe potential changes, I think Biden's plan involves increasing the highest rate back up to 39.6%, which is what it was 2 to 3 years ago before the Tax Cut and Jobs Act. So, yeah, it'd be interesting to kind of see what comes of the election and what comes of any potential tax changes.
Yeah, and also part of the, potential proposed change would be capital gains. Right now our capital gains, the highest rate is 20%. So there are talks of that even increasing back to ordinary income tax rate, which could be as high as 39.6. And this is just on the federal side. And I know, Jason, you used to be from California.
Right. Yes. Fortunately, I'm not. But if California gets their way with that, back taxing people for 10 years, they would get the last year I was there because I left in 2011. So I could still be liable for tax.
Yeah.
Yeah, I can't imagine that's constitutional, but that'd be a long discussion. So let's move on.
Yeah. So we're talking about, that's what's unknown. We don't really know what the future of tax rates and deductions are, what's going to go away. But what we do know now, as of today, is that there are still a lot of great tax benefits for real estate investors, specifically for this year. And so those are going to be the main things that we touch on.
Yeah, and it should come as no surprise, but obviously people with, the same amount of income can and do pay very different level of taxes. And, that was the case 3 or 4 years ago. That's still the case. It's probably going to be the case a year from now, depending on what happens. But, just because you make $200,000 and your neighbor makes $200,000 doesn't mean you pay the same amount of taxes, obviously. So I think a lot of people know that, but I think some people do forget that actually. So, and
that's one reason you need a good tax preparer. You need to have your own knowledge about taxes as well, so that you can talk intelligently with them. Okay, good.
One of the reasons that we see real estate investors continue to overpay in their taxes, even though they already are investing in real estate, is that, they're not viewing themselves as a business owner when it comes to taxes. So, everybody knows like, hey, as a business owner, you get to write off all sorts of things. And what we have on the slide now is home office deduction as one of them, right? People know business owners can write those off. But a lot of times real estate investors don't think of themselves as business owners. So they maybe think, oh, well, I can't take that deduction maybe because I don't have an LLC or I don't have a corporation or I'm not a real estate professional. And all those things are actually incorrect. So as a real estate investor, you are a business owner in the eyes of the IRS. So for the vast majority of deductions that you hear people talk about, as an investor, you are able to take a bit, whether or not you have a legal entity, whether or not you're claiming real estate professional, these are all still legitimate businesses. So let's touch on home office first, because I think that one, most, if not all investors we know have an eligible home office.
Yeah, and I think this is also one that gets unfortunately overlooked a lot just because people either don't know enough about it or maybe even don't even think it adds up to be enough of a deduction. But, obviously based on our experience of preparing hundreds of returns every year, this can add up very quickly to $2,000-$3,000 deductions. So it can provide a lot of savings. So essentially the home office is if somebody's got a dedicated office space at home that they're working from, a dedicated space that is not shared as a kitchen or a dining room table or something, then they would be eligible to take a write-off for a portion of the things that they don't otherwise usually get the write-off. Because we all know as real estate owners, investors, your primary residence, you're writing off your mortgage interest, usually your property taxes, usually, but it's the other things that now you can take a percentage deduction on your utilities, your insurance, HOA fees, repairs and maintenance, cleaning, things like that.
I don't know if you've heard this before, Jason, but we always hear clients tell us like, oh, my CPA said I can't take this because it's a huge audit flag and it means I will be audited. And we've actually seen no truth to that at all. We have so many clients that claim home office. Really haven't had one that was audited for home office deduction purposes. And nowadays, everybody's working from home, especially with the current.
I think in the current environment, the home office will not be very scrutinized at all going forward. So good. Let's move on from the home office.
Yeah, I think another area that we kind of help our clients or look at them focusing on is what we call income shifting, but really it's a way to incorporate your kids or other family members into your business. Because we get the question a lot, is like, well, how do I deduct my kids? Well, it's probably not phrasing the question the right way, right? It's like, how can I pay my kids and take a tax deduction is kind of the better way to look at it, right? You can do that by incorporating them in your real estate business. So it can be having them help you with, advertising for your rentals or putting flyers out or doing internet research or whatever it is that they can do to help you in your business. It's a way that you can start paying them to take a tax deduction for it, save money as a family, because we all know that you're obviously giving the money to your kids anyway already, right? So now it's looking for ways to get a tax deduction for doing that.
Yeah, I think the older the kids are, the more expensive they get. When they're younger, you get them little toys. They get older, they got cars, they got tuition. So it's a really great way because if you just bought your child a car, generally it's not deductible. Right. But if you instead pay them to help out in your real estate business, then that's a deduction. Then your kids can take that money and pay for their own car or, pay for their college and all those good things. So, and
you're also hopefully teaching them some worthy life skills, right? So that's good.
Right. I mean, I like to think in this picture that this kid is showing the dad how to use Zoom. At first you're like, hey, maybe the dad's teaching the kid something, but I don't think so.
Yeah. You're a tech consultant. All right. What else? Let's make sure we touch on real estate professional. I know that's a big one for a lot of our listeners.
So I know you talk a lot about depreciation, or you have in the past, with respect to that being a great benefit for real estate investors. And, one of the things I think a lot of people are confused on is for depreciation. One of the things we love about depreciation is that it's a paper loss, but it's not just on the down payment that you make to a property. It's actually based on the purchase price. So we like to look at it as, hey, you're getting a write-off on the bank's money today, right? So if you buy a $100,000 property, it's the same depreciation whether you paid $100,000 cash or it was 100% leveraged. And so, when we have clients that have high income, we say, okay, well, how do you wipe out the income with a lot of write-offs? If I have $100,000 to invest, if that could turn into a $300,000 property or $400,000 property, the tax deduction could be 3-4 times what it would otherwise be if you're just doing a, all cash deal.
Amanda, I'm so glad you said that, because the depreciation, number one, it's in my eyes, it's the holy grail of tax benefits. It's a non-cash write-off. Like you said, it was a paper loss. I call it a phantom deduction, whatever you want to call it. But you also get the leveraged advantage of that, meaning that if you put 20% down on the property, you get to multiply that depreciation deduction times 5, because, it's not only the money you put into the deal, but it's the 80% the bank put into the deal. So you get to depreciate all of that. And again, as long as you can 1031 exchange it and never recapture that depreciation, that is a beautiful, beautiful thing.
Yeah, I think one way we like to look at it too is, it creates tax efficient cash flow, right? Like the goal is obviously to get positive cash flow. But if you can use depreciation and, home office, income shifting, all these other strategies, the idea is to get enough deduction to bring that at the very least down to zero. So you got tax-free money in your pocket, right? So, but, obviously with depreciation, kind of the standard way of doing it, a lot of people know, some people know, residential properties, they write it off evenly over 27 and a half years. Non-residential, you write it off over 39 years. But there are ways to kind of what we call, almost supercharge it, right? And that's using a cost segregation study. So a cost segregation study is just you're going into the property and looking at how do we break out the components of the building so that I can take faster depreciation or shorter depreciation life. So I can, write it off over 5 years, 7 years, 15 years. Over the life of the property, you're getting the same amount of depreciation. It's just the goal is how do we take more of it sooner than later?
You get to accelerate that depreciation because different components of the property depreciate on different schedules. So the appliances are on a faster schedule than 27.5 years, for example. Now, The reason you do the cost segregation study is because you're segregating out these faster depreciating items, and then you can write them off more quickly. But the problem has typically been that this is economical on a larger property. It's been commonly used in large commercial properties. I've used it on a couple of apartment complexes that I've owned. And, I remember the last time we did one, we paid $28,000 to have a cost segregation or cost seg study. And it was worth paying $28,000 because the tax benefit was much bigger than that. But on a single family home, I have done some shows, some episodes where I've had people on that charge between $500 and $1,000 to do a cost seg study on a single family home. And with that, you can save more money than you spend on that study, and that's great. And you say some others. Again, this is a pretty small world of people providing these cost seg studies on single-family homes, at least economically. So please send those over to me, and I'll put them in the show notes. And everybody can look at them on the show notes for this episode, okay, if we get them in time. So that's really great.
And I think it's a common misconception. We have clients who, own 5, 6, or a dozen single-family rental properties, and they're under this assumption that, hey, those are only for multifamily, large multifamily, doesn't give me a benefit. At the end of the day, like with anything else in business and investing, it's a cost-benefit analysis, right? If you have 5 single-family homes, each costing, $300,000, $400,000, $500,000, that building basis might be much larger than one apartment that you own in Ohio, right? So it's all based on, what the purchase price of the property is. So we put together just an example what cost seg can do, especially in this year where we have bonus depreciation, meaning not only can you accelerate some of these assets into shorter lives, but you can actually claim an immediate deduction for a big part of the purchase price of that building. So, so for our example, we said, okay, let's say you purchased a rental property for $300,000. It's a $60,000 down payment, right? Again, we don't care what the down payment is, but we bought it for $300,000. And let's say the building value is $250,000 with cost segregation.
Meaning the land is $50,000.
Right. And that's not a California property, right?
Right, obviously. But we don't recommend investing in California properties anyway because they're too darn expensive. So so you've basically got a $250,000 improvement value or building value, $300,000 total price, meaning that by deduction the land is $50,000, and you put $60,000 down. And you're saying the first year with a cost segregation study, you could potentially get up to $75,000 in deductions for depreciation, right?
Correct. So your write-off is more than your down payment even.
Right. Now, so it depends on your tax bracket now. Yep. So here in this example that we're looking at on the slide, if you're seeing the video on our YouTube channel, it's a 37% tax bracket, meaning you would get a first-year tax savings of $28,000 when you put $60,000 down. So you get like half your down payment back, which is pretty awesome. But what if you live in, and no offense, because I used to live there too most of my life, the Socialist Republic of California, and you pay, say, 13.3% in state taxes? Do you get an additional deduction for the state tax component or no?
No, unfortunately, California is one of those few states that does not allow large rental losses. California does not recognize real estate professional.
It also doesn't recognize bonus depreciation. So that's one of the big issues. So
that's the reason in our scenario, you see, we didn't include the state. But of course, if you live in another state, maybe that's more reasonable, right? The tax savings could be federal as well as state taxes. So it's huge when you kind of add layers upon layers of different strategies to see what the potential tax benefit is going to be. Okay,
very good. All right, keep going.
Yeah, and I think you kind of alluded to this earlier. I think, we think, based on our experience, cost segregation and real estate profession, when you can combine them together, that really is the holy grail of tax planning for real estate investors. And, real estate professional, what we're talking about is, a lot of people may not know, but when, if you're generating losses from your rental properties, and when we say losses, we're talking about paper losses, right? We're hopefully you're not losing money on your cash flow. But if you have losses from the rentals, the goal would obviously be able to use those losses to offset your other income. Now, the IRS says you can do that to some extent if your income is below $150,000. But if your income is above $150,000, then what do we do, right? Well, that's where being a real estate professional can come in play, because if you or your spouse, if you're married, if one of you can qualify as a real estate professional for tax purposes, then any losses you generate in the current year from your rentals can be used to offset all of your other sources of income without limitation. So if you've got W-2, you've got interest, dividends, business income from other businesses.
So let me just explain that a little bit more for people. So basically, if you are designated by the IRS as a real estate professional, now don't confuse that with being a realtor or selling real estate for a living. I think, it just basically means you're a professional investor. And there are some hurdles to jump through to get that. Not everybody will be eligible. But normally, the passive loss, mostly depreciation, we'll just call it depreciation, tax benefit phases out when your adjusted gross income is above $150,000 per year. Correct me if I'm wrong on any of this, okay? You guys are the experts, I'm not. But this gives you a way, if you're a real estate professional, if you have that classification like I do, then you can take unlimited deductions regardless of your income. You can make $10 million a year and take just an unlimited amount of deductions on these passive losses or mostly depreciation. So did I say that correctly?
Yep, exactly.
Okay, good. So the question is, how does one qualify to become a real estate professional? And I know, we've done episodes on this before with other CPAs and so forth, and this can be a bit complex, okay? So, we don't have an hour to discuss it right now because there's ifs, ands, or buts, but just basically tell us how that works, if you would, in a nutshell.
Well, I think you hit it on the nail, right? People are confused with being licensed. So having a license or not really has no impact whatsoever. It's strictly an hours test. And so the key criteria are that this individual, again, whether you or your spouse, have to spend at least 750 hours in real estate in general. Okay. So at least 750 hours. That's the first hurdle. Now, the other requirement is that you have to spend more time in real estate than your other income activities. So if you have a job, you have an S corp, right? Then we look at how many hours are you spending in those activities collectively, and you have to spend more time in real estate than that. So if you have, another part-time job you spend 1,000 hours on, well, you need 1,001 hours in real estate to then be a real estate professional.
Amanda, by the way, I just want to make sure I got this. Did you say 150 hours? Or did you misspeak, or was that, or did it change? 750.
Yeah,
750. Yes, that's the number I know. So 750 hours, but the kicker is that, at least the way it used to be, unless it's changed, 500 of those 750 hours have to be considered active participation. And
the term is material participation.
Material participation.
Yeah, essentially you need to be kind of boots on the ground and, involved, for lack of a better term, in the day-to-day operations of your own rental properties.
Right.
You get to that 500-hour mark. And then, if there's other things you're doing for your kind of your real estate business, you can use that to get to your 750.
Like with your 750, you can consider education to be part of that, right? If you go to a conference or attend our conference on Zoom, right? You can call that part of your 750, but it won't help for your 500.
Exactly.
Your 500 material participation.
Yeah, the way we look at it is that 500 hours really needs to spend on properties you own, not like, education and those kinds of things are just more kind of overhead related things.
Sure.
But yes, of that. And it's the same test. Sometimes people are confused and say, I need 750 and 500. No, 500 is part of
the 750. So it's not that hard. But what about income? Like, what if someone is, a doctor and say they are not working that many hours and they're not married? Okay. So they don't have a spouse that can qualify. It's just got to be them. But say they make $300,000 a year as a doctor, but they don't work that many hours. So they can still get 750, in, and we're teaching a lot of our clients how to self-manage their properties so that they can materially participate in them. People can self-manage their properties long distance. It's actually quite easy. We teach people how to do that all the time. Can they qualify with that $300,000 doctor income, even though it's not that many hours?
There's no income. When you look at real estate professional status, again, it's strictly a times and activities test. They don't really, I've not seen them to take into consideration how much other income you're doing. Now, having said that, for this position, their time has to be reasonable, right? So they made $300,000. In reality, how many hours do they spend? And that would be the number of hours that is compared against real estate professional status.
Okay.
We have a lot of clients that are now involved in short-term rentals. I don't know which your clients probably have as well. So there's a little loophole in there that a lot of people might not know with respect to using rental losses from short-term properties to offset other types of income.
Yeah, we have clients that maybe they can't qualify as a real estate professional just based on their the hours or whatever. But if they happen to have a couple of short-term rentals, if they can meet the short-term rentals are, kind of treated differently in the tax world. And when we say short-term rental, we mean, when you look back over the year, if the average customer use is 7 days or less, then you've got a short-term rental property. So, Airbnb, one of those type of things where people are booking for 4 or 5 days at a time, that type of thing. But if they can materially participate in their short-term rentals and they've got losses on those rentals, those short-term rentals, they can use those losses to offset their other income without having to qualify as a real estate professional. And we've got a lot of clients kind of going that route just because they like that marketplace. They like the Airbnb model, if you will, for lack of a better term. But so that's an opportunity I think
Sure. And we do a little bit in the short-term rental world, and I gotta just give a caution. A lot has changed in that world due to COVID. So be careful. Okay. Make sure you listen to our podcast for a lot more on that, but go ahead. Okay. Anything else on real estate professional that you want to share?
I think the key to being real estate professional and claiming it correctly is to document, right? Document your time. I always recommend doing it throughout the year because normally when people get audited, it's not going to be right away. After you file a tax return, it's going to be 2 or even 3 years after the return is filed. And, if anyone's like me, I can hardly remember what I had for breakfast 2-3 days ago, right? It's going to be difficult 2-3 years from now to figure out what did I do on this particular date for a real estate professional. So documenting time is sort of, going to be in the insurance policy to claiming it correctly and legitimately.
Good point. Okay, good.
Yeah. So, like we talked about, the current tax law, highly favors real estate investors. It'll be interesting to see what happens with the election and whether that changes or not, obviously. But, we do tell people all the time, it is important to work with their advisor throughout the year, not just, right before April 15th. Because, if you come to us on April 1st with how do I save taxes from last year, your options are severely limited compared to if you're talking to them in October or November, for that matter,
Yeah. Tax laws can change any time, so you got to take advantage of it while you can.
Yeah, good. Any questions I didn't ask you or anything else you'd like to share? And then let's wrap it up.
I think, being the time, obviously this is changing times, in the country, but also just from a tax perspective too. But one thing is always stands true, Matt mentioned proactive tax planning. But, before the end of the year is really a great time to do year-end planning, because this is the last ditch effort. It was, okay, how are we doing on real estate professional time? Do we need to buy more rentals before the end of the year so we can get more depreciation? Should we do cost seg? So, before the holidays, try to allocate some time, meet with your tax advisor and get some action steps in place so that, you're sitting pretty by next April.
Good stuff. Give out your website.
Our website is www.keystonecpa.com. That's KEYSTONE CPA.com.
All right. Amanda and Matthew, thank you so much for joining us.
Thank you for having us. Appreciate it.
Thanks, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.